This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Setting the stage, can the Federal Reserve get investors ready for a rate hike without rattling the markets?
Cutting the fat. The FDA bans the use of trans fats, but is the agency just playing catch up to what major food companies are already doing?
Paying out of pocket, insurers want to merge and hospitals are getting bigger. But in the end, what does that mean for the cost of your care? All that and more tonight on Nightly Business Report for Tuesday, June 16th. Good evening, everybody. I'm Sue Herrera.
And I'm Bill Griffith in for Tyler Matheson once again tonight. Well, it is here. The June meeting of the Federal Reserve is upon us. Monetary policymakers began their two-day meeting today. And while most do not expect the central bank to announce a move on rates tomorrow, many are expecting the Fed to signal very clearly that a historic rate hike will occur, and maybe soon. And Fed Chair Janet Yellen is going to have to choose her words carefully so as not to surprise investors and jar the market at the same time. Steve Leisman takes a look now at what some of the top money managers, strategists, and economists are expecting.
As the Federal Reserve began a two-day meeting, a new survey showed Wall Street firmly believing the central bank would hike rates this year. Just not tomorrow, or next month, or the month after. 92% of respondents to the CNBC Fed survey see a hike coming in 2015, but not until, on average, September. Even when the Fed starts hiking, the 39 respondents, including economists, fund managers, and analysts, see the Fed increasing short-term interest rates only modestly in the next several years.
I think they're going to tell us, start to hint, it's going to be in September. It's going to be a very small increase. We're going to skip a bunch of meetings potentially between hikes, and this is a multi-year process.
That means the Fed funds rate and rates in the broader economy should rise. In the next 18 months, the survey suggests the 10-year yield will increase to about 3.25%. But stocks are seen faring relatively well, rising almost 10% over the period. The reason? A lot of folks on Wall Street think the market has already priced in Fed rate hikes, so the actual rise in rates, once the Fed does it, not expected to be much of a big deal.
Typically, the market does dip almost every year, and especially around Fed hikes, but corrections usually don't occur when inflation's low and economic prospects are still pretty encouraging. So, look, I do think we're going to get turbulence. I do think it's likely to be a dip to buy.
The challenge for the U.S. economy is the dollar. Higher rates usually cause more flows into dollar-based assets and strengthen the greenback. A stronger dollar can then hurt exports. And many economists worry not so much about the effects of higher interest rates from the Fed, but about the effect of a stronger dollar from those higher interest rates. For Nightly Business Report, I'm Steve Leisman.
Well, stocks rebounded ahead of that Fed meeting as investors put growing concerns about the Greek debt crisis on the back burner, at least for now. The Dow Jones Industrial Average was about 113 points higher to close at 17,904. The Nasdaq notched a 25-point gain, and the S&P 500 rose 11 points.
In economic news, a sharp drop in housing starts in May after that big surge we saw in April. According to the Commerce Department, builders broke ground last month on almost 1 million privately owned homes, but that was down about 11% from the prior month. There were some encouraging signs, though. Applications for new building permits rose by 11%. That was better than estimates.
U.S. government debt held by the public is expected to rise to more than 100% of the economy by 2040. The Congressional Budget Office says that's up from 74% this year. The CBO says the trend could be harmful to economic growth and that lawmakers should make major changes to tax policies and spending.
Also on Capitol Hill, the House of Representatives voted today to extend the deadline on a key trade-related vote. The House lawmakers now have until July 30th to reconsider the part of that trade package that supports workers that are hurt by trade. This is the same bill that failed dramatically last week.
The Food and Drug Administration today moved to ban trans fat from foods. The FDA calls it an important step forward for public health, and it's part of a broader trend towards healthier eating. Sarah Eisen has more.
The healthy food movement is picking up steam. The FDA today ordering food manufacturers to phase out their use of trans fats over the next 3 years. You find them in foods like margarine and baked and fried items, and they've been linked to heart disease. But the FDA is playing catch-up to companies in the food industry like Panera, which banned trans fats back in 2006.
We've been on this journey for 2 decades. 11 years ago, We were the first national restaurant operation to serve chicken raised without antibiotics. Today, you have people like McDonald's following us. It was 6 or 7 years ago, we were the first people to pull non-naturally presenting itself trans fats from the menu. Today, you have the U.S. government literally today announcing all restaurant chains and all the food must do it. We did the same thing with caloric information 5 years ago.
Panera is pushing the healthy food angle even harder, announcing a new ad campaign today and opening a pop-up store in Lower Manhattan to highlight some of its menu changes, emphasizing fresh, natural ingredients with no artificial flavors. The head chef, Dan Kitch, is in charge of an ambitious change that affects the company's 2,000 stores nationwide.
The tomato mozzarella flatbread, a year ago it was a big heavy panini. And we said, well, it's meatless, it's sort of right for the time, but how do we lighten it up and make it a little more contemporary? So flatbreads came on this time last year as a way to make sandwiches a little bit lighter and healthier.
Chipotle has recently gone a step further, removing all genetically modified organisms, or GMOs, from its restaurants. And companies like McDonald's, Costco, and Taco Bell have recently pledged to cut the use of antibiotics in their meat and chicken.
We really do believe in raising, serving, and eating good food that's both good and good for you. Food as it should be.
The risk here, changing ingredients and processes can be complicated and costly for big companies with deep supply chains. And if those changes lead to higher consumer prices, it could hurt sales in an effort to drive growth. For now, consumers say they want healthier choices, and companies like Panera are hoping that big marketing and advertising campaigns can help attract consumers, health-conscious young millennials. For now, we'll have to see whether those consumers are willing to put their money where their mouths are. For Nightly Business Report, I'm Sarah Eisen.
Well, a possible wave of consolidation in the insurance industry may impact consumers' pockets. Big players like UnitedHealth and Anthem are reportedly looking to merge with smaller rivals. But what will less competition mean for consumers? Let's find out from Limor Daphne. She's Director of Health Enterprise Management and Professor of Strategy at Kellogg School of Management. Good to see you. Thanks for joining us tonight.
It's a pleasure.
Those who are in the managed care business, the stocks have been rising sharply on talk of possible mergers in that sector. So Wall Street's excited. How do you think antitrust regulators feel about this?
I think the antitrust regulators are going to look very closely at these transactions. The best available economic evidence out there suggests that when insurers consolidate, premiums go up, and the antitrust enforcers have to look closely at what happens to consumers.
And it's not only the costs go up to consumers, but providers technically or usually get paid a little bit less. They don't have as much clout.
There is some evidence that providers do get paid less, and interestingly, no evidence that to the extent that there are price decreases to providers, that these get passed on to consumers. So I would expect regulators to ask some really hard-hitting questions, particularly in those geographic markets and product segments where the combining firms would have significant market share.
So I'm confused. If they are merging to achieve scale so that they can bring costs down, if it means, though, you're saying premiums are going to go up and they get paid less, then why merge in the first place?
The providers might get paid less. That doesn't mean that the insurers would pocket less. The real question is if these insurers can reduce costs through scale, and that's a big if, why, if they have less competition in the marketplace, would they pass on any of those reductions in costs? What is the market imperative to price competitively when you've swallowed some of your rivals?
What about the quality of care? Is there any indication that the quality of care changes when you have fewer insurers really looking at that landscape?
It's a fantastic question, one that we don't know the answer to. We just know that when there is less competition in a marketplace, there tends to be premium increases, and we would naturally expect that there would be potentially a reduction in quality of plan as well, simply because you don't have to compete as hard to gain business. So the real question is, with these transactions, Are any of them motivated by the potential to really bring down costs and improve quality? And what mechanisms are in place to make sure that some of those benefits accrue to consumers?
Well, it is clear that they are talking. We'll find out if these mergers happen and what regulators do about it. Limor Daphne with Kellogg School of Management. Thanks for joining us tonight.
Pleasure.
Still ahead, we all know that college tuition is going up, but why does it cost so much?
Kirk Kerkorian, who built some of Las Vegas's biggest hotels, has died. The billionaire investor was 98 years old. Mr. Kerkorian was an 8th grade dropout. He eventually became the largest shareholder in MGM Resorts International, which he founded in the 1990s. 3 times during his career, he built what were the largest hotel casinos at the time. He also famously tried to take over, but failed to take over Chrysler.
There is some big money in video games, and it's all on display at E3, that industry's biggest trade show. This year, the big topic of discussion isn't just the new games themselves, but also the technology behind them. Julia Borston has more from Los Angeles.
Big-name games are in focus here at E3, like highly anticipated Star Wars Battlefront, expected to sell well across platforms. But both Microsoft's Xbox and Sony's PlayStation 4 are highlighting exclusive deals to try to lure gamers. Microsoft's Xbox has Halo 5, Guardians, and Sony's PS4 promoted exclusive content for blockbuster franchises, including Call of Duty Black Ops 3. Microsoft announcing it will make older Xbox 360 games work on its new Xbox One by the holidays to help it catch up with Sony's PlayStation 4, which has sold about twice as many consoles.
I think it's going to be a big deal. I think we were on the edge of people who were waiting, and this will be the thing that'll flip over.
Sony talking up PS4 as a media hub, announcing its PlayStation Vue streaming TV service will soon allow customers to buy some individual channels rather than just bundled subscriptions.
We understand that when people aren't playing games, they may be doing things like watching TV. So we want to be able to provide that opportunity for them across the PlayStation platform.
Gaming's next frontier, virtual reality, expected to be a multi-billion-dollar business. We still don't have price tags or launch dates for the headsets coming from Oculus, owned by Facebook, or Sony's Morpheus, but those platforms are drawing big crowds here at E3.
Sony showing off its Morpheus virtual reality headset with a multiplayer mode, also announcing a half-dozen titles that work with the headset.
Morpheus brings to video gaming kind of what the smartphone brought to the cell phone business. It's a complete step change. It's something entirely new.
And Microsoft showcasing its HoloLens augmented reality goggles, projecting an interactive Minecraft game onto the world around you. Xbox also partnering with Facebook's Oculus Rift, here showcasing new hand controls.
We've really focused on trying to make this an extension of your actual hand, your arm, and make it really feel like this is your hand inside of VR. And hand presence is something that we really, really believe in.
But some game makers here caution not to expect a virtual reality revolution overnight. Electronic Arts CEO says it'll be years, not months, before VR impacts EA's bottom line. For Nightly Business Report, I'm Julia Borston in Los Angeles.
Box and Microsoft are teaming up, and that's where we begin tonight's market focus. The cloud storage provider is integrating with Microsoft Office, enabling users to browse and open and edit Office files directly on its service. Box says the deal will drive business productivity. Microsoft shares rose today, up 36 cents, while Box was up 4.5% today to $17.90. Meanwhile, shares of Oshkosh took a big hit in today's session. The specialty truck maker cut its profit forecast for the full year, saying that sales and profit were hurt by bad weather in the third quarter. And because of a delay in launching a product, Oshkosh tumbled by 8% as a result to $46.26. And Coty is close to a deal to buy 3 businesses from Procter & Gamble for as much as $12 billion, that according to reports. The deal would make the cosmetic company the world leader in perfume and hair care. Shares of Coty surged by 19% to $31.08. Procter & Gamble was up by 1% to $79 and a dime.
But wait, there's more deal speculation. Blackstone and Carlyle Group are making a joint bid for NCR. The leveraged buyout of the computer company would reportedly be the year's biggest at more than $10 billion. Shares rose almost 11% to $34.73. And as we told you last night, Gap is closing 175 stores and eliminating 250 positions. Today, the company's CEO explained the thinking behind the move.
By these decisions today, I think we streamlined the organization, and we frankly eliminated some of the complexity in the fleet that wasn't getting us very far to get back to a fleet that we're proud of and we can do business in front of our customers.
The stock closed at $38.75, a gain of 55 cents. Adobe reporting an increase in profit and revenue as more customers subscribed to its cloud services. But the maker of Photoshop issued an earnings outlook for the second quarter that was below estimates, so shares dropped off initially after the close. Before the bell, though, shares were up almost 1%, or a little bit more than 1%, to $79.94.
Federal Express is scheduled to release its fiscal third quarter results tomorrow. Declining fuel prices are expected to help its bottom line, and so are some recent changes to its pricing strategy. And it's not just FedEx that's focusing on shipping rates, but also rival UPS. Morgan Brennan has more.
This holiday season, UPS will do away with discounts it offered customers on some oversized packages. That, according to the Wall Street Journal. Changes in shipping rates that could mean higher prices for consumers. UPS is not confirming that plan, but the company does say it's looking to meet customers' needs while, quote, also ensuring UPS is appropriately compensated for the valuable services we provide. It all sheds light on a strategy shift underway at the delivery giant, one much more focused on pricing.
It seems to be is initiating more of a pricing strategy where it's going after some of its retail customers and looking to price up some business, particularly the e-commerce business, which has been a bit of a headwind to it.
Since the start of the year, both UPS and FedEx have raised rates and introduced pricing formulas for ground packages based on a combination of size and weight. UPS has also said it's considering shipping surcharges for the upcoming holiday season. Couple that with a growing focus on multi-channel retailing, or delivering packages to local stores for consumers to pick up, a process that's 3 times less costly than home delivery. And analysts say parcel carriers, particularly UPS, are looking to maximize their shipping capacity and boost margins, even if it means turning down some business. Now, that may sound obvious, but it represents a big challenge given how tight capacity has been and how narrow returns typically are on e-commerce shipments. The new strategy is already beginning to play out with UPS, but also with FedEx, which experts say has been taking the lead on higher pricing.
Our expectations are that FedEx will continue to push on pricing throughout the rest of this calendar year and into the holiday season as well. With UPS now supporting those pricing initiatives, we actually think there's a lot more momentum for both of the small package carriers, and ultimately retailers are going to bear more of the cost of shipping as we move towards the holiday.
UPS also announced the acquisition of Parcel Pro, a logistics company specializing in shipments of valuable jewelry and collectibles. Another move to help manage growing e-commerce demand. But as parcel carriers attempt to realize higher returns, other companies are upping the competition. For example, Amazon, which is reportedly considering paying ordinary people, rather than the carriers, to drop off packages en route to other destinations. For a Nightly Business Report, I'm Morgan Brennan.
Wall Street bank Goldman Sachs is reportedly making a push onto Main Street. As first reported by the New York Times, Goldman Sachs will soon offer loans online to both consumers and to small businesses. But its plans are still in the early stages. The move is part of a broader shift towards consumer and business lending.
Well, there's also a shift happening in the retirement industry. Get this, withdrawals from 401k plans are now exceeding new contributions. According to Brightscope, investors pulled $11 billion from tax-deferred savings plans in 2013, and the trend out of 401ks is expected to accelerate as more baby boomers retire.
The cost of higher education is only getting higher. Tuition and fees at a four-year public college topped $9,100 on average for the 2014-2015 academic year, nearly triple what the cost was 25 years ago. Over the same period of time, tuition and fees at a four-year private university, they've almost doubled to over $31,000. But how did college get so expensive? Sharon Epperson knows. She joins us. And Sharon, the numbers really are pretty alarming. Is the cost of higher education basically outpacing other goods and services? It seems to be when you look at it.
It certainly is. If you look at the cost, if you look at the CPI over the last, say, 20 years, it's increased about 60%. You look at the cost of a 4-year public education, tuition and fees alone has more than doubled, up 110%. So we're right when we think the cost of college is getting more expensive.
Outrageous.
It definitely is getting much higher and outpacing inflation.
What's your version of why? Why this enormous cost increase in college the last several years?
Well, there are two things that researchers look at. First, they look at the cost of the education that they're delivering, and they're saying, well, we're offering more amenities and special services, from high-speed internet access all over the campus to rock climbing walls in some special locations, may be driving up the cost. That's certainly happening, but teaching salaries are basically flat. So overall, the cost of delivering education has been pretty stable over the last several years. There's another factor, and that, of course, is the price that you pay. That has a lot to do with subsidies, and both private and public subsidies. If you look at what's happening in terms of private colleges and the median endowment that they're receiving is about $113 million. Harvard's $36 billion. So this is huge wealth gap within those private colleges, and that is causing many of those colleges to have to say, our funds have to come from tuition.
Tuition, right. Okay, so you've kind of highlighted why things are going up, but you know, is there a way to cap some of those costs? Some of these universities and colleges are also very competitive. They want the students, and if they want the students, they have to keep upping those amenities that you talked about.
Exactly. Well, some of the public colleges are saying, well, look, we're also seeing spending cuts, so that's impacting, and that's throwing some of the cost on the students. I think what's happening is that they're just having to borrow more, the students and their families, and what is having to happen is they're going to have to be educated on how much they can really afford to borrow and whether it's worth it to pay those high prices, whether their return on investment is really going to be worth it.
Gee, I'm glad I don't have to worry about this
I was
anymore.
going to say that. You're
For those
done.
of us who have to worry about it.
You're done, and aren't you glad? Sharon and we're going to form a support group.
Exactly.
Thanks, Sharon.
Thanks, Sharon, very much. Well, coming up, imagine going where no man has gone before, even if you're just going to work. We'll explain. Head to China, coming up.
And here's what to watch tomorrow. In addition to the Federal Reserve statement, we'll also get a read on the housing market with a report on mortgage applications. Oracle will announce its earnings after the bell. And that is what to watch for Wednesday.
Meantime, Honda has added more than 1 million cars to that massive recall involving those potentially faulty Takata airbags. Today's announcement includes Accord and Civic sedans, and it comes as regulators have expanded their own recall. Several car makers are fixing these airbags in nearly 34 million vehicles as the auto part can violently explode.
A Chinese CEO is exploring new frontiers. He's taking his love of Star Trek and millions of dollars to build his company's headquarters in the shape of the legendary spaceship. Eunice Yoon has more now from Fuzhou, China.
The Starship Enterprise, its mission to explore the final frontier, or in this case, the city of Fuzhou in eastern China. That's no Trekkie fantasy there, it's actually the corporate headquarters for internet pioneer DJ Liu.
This is actually my office.
From his office, Liu captains his online gaming company, NetDragon.
So why did you want to design the building to look like the Starship Enterprise?
I love the idea of boldly go where no one has gone before.
The entrepreneur got hooked on science fiction while studying at the University of Kansas.
Star Trek was a very important teacher to me. I love the idea that space is sort of the final frontier. And, that people want to go there and do things new. And it's sort of becoming my way of understanding life.
The $100 million headquarters can sometimes feel like the inside of a starship, where sliding doors open to the United Federation of Planets.
So what's this?
Oh, it's actually a bathroom.
Liu has invited other famous space invaders to take up residence as well.
Do you have a favorite character for Star Trek?
I have to say Captain Picard.
Not sacrifice the Enterprise.
Do you see yourself as Captain Picard?
I try to see myself as someone try to figure out what is the right thing in the world and stick to it. And that, in that sense, hopefully I can become someone like Captain Picard.
Liu has been leading NetDragon ever since he founded it in 1999. He and his staff focused on online games, releasing hits like this one, generating revenues in the hundreds of millions of dollars for the Hong Kong-listed company. Now, Liu wants to branch out into online education and robots and push further overseas. Liu's creation is more than an expensive tribute to a TV show. It's meant to inspire his staff.
The most important thing is that we have to think a little bit ahead of us, try to accomplish something seemingly impossible.
A dream come true that could take his company into warp speed. Eunice Yoon, CNBC, beaming up from Fuzhou, China.
And to read more about the Star Trek-like headquarters, head to our website, nbr.com.
Finally tonight, the 25 richest self-made billionaires are out, according to a survey by WealthX. Their combined wealth is larger than Norway's GDP, believe it or not. Third on the list, Amancio Ortega. He's the co-founder of the clothing store Zara. His estimated net worth, $65 billion. Second, as you see, Berkshire Hathaway's Warren Buffett, who's worth $70 billion. And topping the list, Bill Gates. His net worth now something around $86 billion. Not bad for a Harvard dropout.
That's Nightly Business Report for tonight. I'm Sue Herrera.
I'm Bill Griffith. Have a great evening. We'll see you tomorrow.